Imagine you're a compliance officer at a major bank in London. You've just received a wire transfer request from a client. The money is coming from their company account in Switzerland, passing through a correspondent bank in the Cayman Islands, and is destined for a real estate purchase in Dubai. Your job is to assess the money laundering risk. But here's the catch: you're not dealing with one set of rules. You're dealing with at least 4 different jurisdictions, each with its own legal philosophy, regulatory rigor, and definition of what constitutes suspicious. This is the daily reality of global finance. Money laundering is an international crime, but the laws to combat it are fiercely national. There is no single global police force or uniform code. Instead, we have a messy, often contradictory patchwork of regulations that create both strongholds of enforcement and glaring weak spots that criminals actively exploit. To understand the flow of illicit finance, you must understand this map. Today, we're going to chart it. We'll start with the closest thing to a world government on this issue, then descend into the major regulatory blocks, and finally look at the jurisdictions that have built their economies on being the gaps in the system. This isn't just academic. It explains why some places become magnets for dirty money and why cracking down on it is so diplomatically charged. At the top of this ecosystem is a unique, powerful, yet toothless organization, the Financial Action Task Force, or FATF. Established by the G7 in 1989, the FATF is not a lawmaking body. It cannot arrest anyone or levy fines. Instead, it is a standard setter and a name shaper. Its power comes from its 40 recommendations, which are the international benchmark for a robust AML framework. Countries are expected to translate these recommendations into their own national laws. To encourage compliance, the FATF conducts mutual evaluations and, most famously, issues the critical lists, the gray list, and the black list. The gray list is a public statement identifying countries with strategic deficiencies in their AML regimes. Being gray-listed is a severe reputational and economic blow. It makes international banking relationships more costly and difficult, as transactions to and from that country are subjected to enhanced due diligence, essentially putting them under a financial microscope. The blacklist, officially the high-risk jurisdiction subject to a call for action, is for countries the FATF deems as having critical, unaddressed flaws. The consequences are severe, often leading to de-risking, where global banks sever ties entirely to avoid the regulatory risk. The FATF's process is deeply political. Smaller, developing nations often bear the brunt of listings, while larger, influential economies face less public scrutiny despite known vulnerabilities. The insider perspective is that the FATF's true power is in creating a peer pressure mechanism that forces a baseline level of compliance across most of the globe. But the enforcement of its standards is wildly inconsistent. Now, let's look at 2 major regulatory heavyweights, the United States and the European Union. Their approaches are different in philosophy but similar in rigor. The United States operates under a complex web of laws, but the cornerstone is the Bank Secrecy Act of 1970. The BSA is fundamentally transaction-focused. It mandates that financial institutions are gatekeepers, requiring them to report certain activities, currency transaction reports CTRs for cash over $10,000, and suspicious activity reports SARs. The key is the extraterritorial reach of U.S. law. If you transact in U.S. dollars, clear through a New York bank, or even have a remote correspondent relationship with a U.S. institution, you are subject to the long arm of American regulators. The pro tip in global finance is that the U.S. dollar clearing system is the ultimate choke point, giving agencies like FinCEN immense global leverage. Contrast this with the European Union. The EU's approach is directive-based. It creates laws like the Anti-Money Laundering Directives AMLDs, which member states must then transpose into national law. This aims for harmony but can lead to differences in implementation. The EU has been a leader in pushing for public registers of beneficial ownership, public databases showing who really owns companies, though this faces pushback from some member states. The common thread between the US and EU is a philosophy of transparency and the imposition of due diligence obligations on the private sector to act as frontline monitors. Then, we have the jurisdictions whose entire financial model is built on a different principle, confidentiality. These are often called secrecy jurisdictions or, more colloquially, tax havens. Think of traditional places like Switzerland historically, the Cayman Islands, Panama, and more modern hubs like Dubai or Singapore. Their laws are deliberately crafted to attract capital by offering financial privacy, lower zero taxation, and light touch regulation. The mechanisms are legal tools like anonymous bearer shares, where ownership is held by whoever physically possesses the paper share certificate, trusts with hidden beneficiaries, and foundations that obscure the true source of funds. For decades, the mere question who is the beneficial owner could be met with a polite, "We are not permitted to disclose that." This created the perfect environment for the layering stage of money laundering. However, the critical evolution over the last 15 years, driven by FATF pressure and scandals like the Panama Papers, is that absolute secrecy is now rare. Most reputable offshore centers now have AML laws on the books and will share information but only upon receipt of a formal, legal request from a foreign authority. The difference is between automatic exchange of information as between EU countries and exchange upon request. The red flag is the speed and quality of that cooperation. In some jurisdictions, a request can be delayed or obstructed, providing a time buffer for criminals. The common mistake is to think all offshore finance is illicit. It's not. But the legal architecture of privacy inherently attracts those who wish to misuse it. This patchwork creates very real, daily dilemmas and opportunities for criminals. A technique known as jurisdictional arbitrage involves routing transactions through countries with weak laws or poor enforcement to break the audit trail before moving funds into a strict jurisdiction. For example, a corrupt official might steal state funds, move them through a series of shell companies in jurisdictions with poor beneficial ownership transparency, then invest the clean funds in prime real estate in London or Vancouver, where the market is stable but the source of funds checks, while existent, can be overwhelmed by complex structures. The key vulnerability is the correspondent banking relationship. A small bank in a lightly regulated country needs access to the US dollar system to serve its clients. It does this by having a correspondent account at a major global bank in New York. That major bank is now responsible for monitoring the trillions of dollars that flow through that nested account, a near impossible task. This is why de-risking happens. It's easier for the big bank to cut off the small country entirely than to bear the regulatory risk. So, what does this mean for you as an individual or business? If you operate internationally, you must practice geographic due diligence. You need to know the risk profile of the countries you're dealing with. Sending a large payment to a company in an FATF gray-listed country will trigger enhanced questions from your bank.